Hey there, everyone. Dave Keller here with Market Misbehavior. Today we're going to revisit one of our favorite exercises, the probabilistic analysis, or what we call our choose your own adventure style video. We're going to look at the S&P 500 and lay out 4 potential scenarios. Here's what you're going to do. Listen to these 4 different scenarios. Consider how they might play out and what sort of investment themes could evolve if those scenarios actually occur. Then, once you've thought about each of the 4 scenarios, drop a comment below and let me know which scenario you see as the most likely and why. And that why is super important, because what that allows us to do is once you've made your vote and shared your why, you can see everyone else's. And so it adds additional value to this exercise. So what's the point of this exercise? So number one, most importantly, it's here to break us free from our preconceived notions, our preconceived biases. I think investors get into a lot of trouble when they make a decision about the markets and then they put on the blinders and they cover their ears and they don't consider alternate points of view. In 2026, with the social media landscape that we're in, with the polarization of all of society, it's as difficult as ever to break out of your little echo chamber. That's the point of this exercise. You are forcing yourself to think about 4 different scenarios. One of those you probably see as the most obvious likely one, but all 4 of these are possible over the next 6 to 8 weeks. So by reviewing these different scenarios, by voting on your choice, but then actively visiting those other 3 scenarios, thinking about what they might look like, what they might feel like, what they might do to your portfolio, that's where we can get ahead of whatever the market is going to give us in the days and the weeks and indeed the months to come. Now, before we get to the current chart of the S&P, I want to revisit the last time we did this Choose Your Own Adventure style video was at the beginning of February. Talk about an opportune time to do this exercise. We laid out 4 different scenarios. A super bullish scenario that would have taken the S&P up near S&P 72 to 7,400. We had a sort of mildly bullish scenario where the trend that we saw in December, January would continue. We had a mildly bearish scenario where the market would drift lower over the next 6 to 8 weeks. As you can see, that almost was exactly what the market did. But eventually, the sell-off in the week after the end of the arrow got almost exactly to the downside objective that we talked about, 6,300. I think this last episode, or last time that we did this, is what's so meaningful. It's a great example of why this is such a meaningful exercise, right? I tell you, there's a lot of optimism in December and January as the S&P is making new highs, testing 7,000 for the first time. And I know there were many expecting a continuation, if not an extension of the current that current uptrend phase from through the end of January. But sure enough, risk off ruled the day as events in the Middle East accelerated as we had crude oil prices spiking and risk assets started to break down quite a bit. So we weren't surprised by how the market played out because we'd already laid out that exact scenario a little bit beforehand. So scenario 3 to 4, I would say both of you probably job well done. Clap yourself on the back. That was well done. Now, with that in mind, let's look at the current chart of the S&P 500 and talk about what the conditions are right now. So the S&P, as you probably know, has powered above 7,000. I know we've been covering that on our market recap show. I even played a trumpet fanfare on the show the day we closed above 7,000. So go to my YouTube channel and you'll see a thumbnail with the trumpet on it. That's the one you want to find if you want to check it out. I hope I did not disappoint and offend you if you are a trumpet player, because I don't play as often as I'd like these days, but we digress. The S&P 500 has powered above 7,000. All sorts of questions as to whether this is the beginning of a new upward leg, a new accumulation phase, driven first by optimism in AI, software, other technology companies, potentially, with optimism through earnings season propels the market a lot higher. Having said that, I'm hearing plenty of discussion talking about how this is a potential blow off top, how we probably could break below 7,000 at any point, and starting to think about some potential downside targets in the case that would occur. So that's the setup right now. We are in a position of strength. The last time we did this was in February when we were also at or near new all-time highs. So this is another new all-time high edition, but we're going to break down those 4 scenarios. Before we get to the chart of the 4 scenarios and their implications, talking through each of them in a little bit of detail, I do want to give a shout out to one of our partners, Seeking Alpha. They have a platform, a product that is called Alpha Picks. They have a quantitative model that I've reviewed in detail and I think is pretty well designed. Their quant team run by Steve Kress does a very good job of using that, using those capabilities, using the quantitative alpha model to generate ideas. And what Alpha Picks is they basically go through his team every month and they pick a couple names out of the strong buy rated names according to the quant model, and they dig into those a little bit deeper. They call those Alpha Picks. As a basket, that group of stocks has done remarkably well in recent years. As always, past performance is no guarantee of future results, but I think you'll find a regular diet of Alpha Picks from Seeking Alpha is going to have your cup running over with potential investment ideas. You can find more information at marketmisbehavior.com/Alpha Picks, or you can just scan the QR code that you see on your screen. In either case, you'll get a good deal on a new Alpha Picks subscription if you take a look. So I hope you'll check that out. And thanks again to my friends at Seeking Alpha being longtime partners of Market Misbehavior. All right, so here is our updated Choose Your Own Adventure style chart. We have 4 scenarios to share with you, starting with the Super Bullish scenario, scenario number 1. The Super Bullish scenario basically implies that the uptrend continues. I honestly don't see a realistic scenario where the acceleration that we've seen in April so far is sustainable at the pace that it is. If so, the number 1 scenario isn't even anywhere close to the upside trajectory we could experience by the by the beginning of June, and we're looking from like late April to early June for this look forward period. So if you want to vote for a 1/2, that means you're so bulled up you think this acceleration, this pop higher in January is just going to continue. I see the most bullish scenario as a slight decrease in slope but continued appreciation. S&P 7400 is kind of the back of the envelope number that I'm assigning to this scenario. Of course, we've seen the stage set for this scenario in the fact that the S&P has powered above 7,000. So I would say this would be in a lot of ways a continuation of what we've observed recently. We would have to see the AI trade and the growth names, the Mag 7, really resuming their uptrend. That means stocks like Apple and Alphabet and those that are kind of up against resistance kind of have to power through and go a lot further to drive the benchmarks to that level. I would also say for a realistic expectation to get to that point, it's got to be a broader advance. We've seen that a number of sectors are not really participating in a meaningful way in this recent uptrend phase. Not all the stocks that I follow are making new all-time highs. So we'd have to see much more improved breadth readings, particularly long-term breadth readings remaining fairly strong. We need a lot of stocks making new 52-week highs to power the benchmarks onward and ever upward, as we like to say. So if that seems like the most realistic scenario, scenario 1, and I should also address, I would say from a macro side, that would most likely have to mean that a ceasefire is in place. Hostilities have either ceased or are very minimal, and we start to get the sense that there could be stability in the Middle East for some period of time. That's scenario number 1. Scenario number 2, maybe some of those things happen, but not all of them, right? If the Mag 7 names continue to show strength, but the rest of the market really kind of struggles and we're back to like growth dominated, I just don't see the upside potential. It's kind of similar to what we saw back here in like December and January. We can go up. I would imagine the volatility remains very low in that situation, but maybe the breadth ratings are not as strong. Maybe some of the cyclical sectors don't really participate. Energy is more of a fluke, and when conditions in the Middle East just don't really deteriorate much, we're able to grind higher. It's just not enough of the mo, and it's really slowing down more like the pace that we saw in December and January, as opposed to the pace we saw back in like May, June, July of 2025. So if that's what you think is most likely, scenario number 2 is the one you want to be looking for. Now we get to the mildly bearish scenario, scenario number 3. I'm kind of extending the 200-day moving average because I would say a reasonable kind of mildly bearish scenario is we go down maybe 200 points or so. That would take us down around 69.30. That would take us right around to about where the 200-day moving average is most likely going to be. We don't know exactly where it's going to be because that depends on the price action. So I'm kind of extending the recent slope just to sort of project it forward a little bit, aiming in kind of that 6,900 to 6,950 range. Maybe again, hostilities start to, re-exert themselves. We start to see ceasefires failing. The Strait of Hormuz is nowhere near open after a couple weeks, and as a result, this risk-on move that we've seen in April starts to turn into more of a slight risk-off move in May. Maybe it's not horrible. Maybe there's still, hopeful optimism that things will resolve quickly, but we're just really not seeing the progress in terms of resolving the issue. Maybe the Strait of Hormuz is still very congested. Maybe we start to feel the impact of higher oil prices and less oil supply as some of those ripple effects start to really take hold. Maybe companies start to talk about inflation and fuel prices as starting to weigh on future earnings, and maybe the remainder, the next couple weeks of Q1 earnings starts to disappoint a little bit. A number of things could certainly cause the S&P to pull back. And it would show that April, at least the beginning of April, as we're seeing through today's close, was more of euphoric anticipation of things being done quicker than expected. When it turns out things are going to take a little longer, scenario 3 becomes quite likely, if not very probable. So if you think that's the most likely scenario 3 is the one that you want to vote for. All right, you always have to have a bearish scenario, what we call a doomsday scenario. So here is the very bearish scenario number 4. I would basically say a retest of the March swing low would be the most bearish scenario I can imagine over the next 6 to 8 weeks. Is it possible for the S&P to go hundreds of points even further? Absolutely. Is that likely? I would say probably not. Earnings season already has started pretty well, so at least there's some optimism there in terms of future earnings growth. So if it ends up being a little more mixed as the next couple weeks emerge, and I would say scenario number 4 most likely would imply that whatever ceasefire kind of diplomatic solutions we're seeing completely fail. Maybe hostilities resume and end up being even worse. Maybe there's a reinitiation of hostilities and it starts to feel like things are escalating again, and the language remains very dire. It would be very easy for the market to essentially give up this April rally and basically go back to where we were in March. And what that would mean would be that this sort of inverted V-shaped pattern would be a euphoric overreaction to the maybe misled expectation that the conflict would be resolved very quickly. And once we sort of come back to reality, as the Strait of Hormuz remains threatened, as energy prices remain elevated, if not accelerate higher, all of a sudden, all we're talking about is how bad things could get because the ripple effects are starting to feel very, very real. So I would say this would be back to the negative sentiment that we would see that we observed in February and March. What's great about scenario number 4 is I think the signs would be pretty telling very quickly that things were getting bad. Number one, breadth indicators would have to start torpedoing lower, and they're really not horrible at this point. They're overall fairly constructive, I would say. But short-term breadth indicators would fail quickly. Long-term breadth indicators would also feel the weight of that. Credit spreads would widen out as bond investors most likely get nervous. The VIX would spike way above 20, and in that scenario, maybe above 30, indicating a return back to the fearful vibe that we observed in February and March. So the good news about scenario number 4, I think it would be the most obvious because I think you would see the shifts very quickly in risk assets and related indicators. But all of these scenarios are very likely. So there you go. Those are your 4 scenarios and what those might look like, what could drive some of the different factors here. And again, be thinking about, number 1, which scenario you think is most likely. Make sure you drop a comment below and let me know. But also take some time to review those other scenarios. And as a reminder, before you vote, if you're doing it now, scenario 1 is the super bullish scenario. The S&P around 7,400 by early mid-June. Lights out positive, tech works, everything else works too. Scenario number 2, the mildly bullish scenario. Maybe Mag 7 stocks still do okay, but it's not enough of the other stuff. Maybe we remain in sort of this uncharted, unknown territory where we're still kind of waiting for ceasefires to take hold, but things just aren't getting that bad. I could see a slower rally in the form of scenario 2. Scenario number 3, the mildly bearish scenario. Maybe we retest the 200-day moving average. Maybe we start to, the economic implications of the events in the Middle East start to take hold. The negativity and the pessimism there brings the stock market lower with the S&P down to the 200-day. The super bearish scenario, things get bad and things get bad quick. That inverted V is possible if we start to see a reinitiation of negative headline. So 1, 2, 3, 4. Which scenario do you see as most likely and why? Make your vote, explain why, and then after you've done that, take some time to review the other votes. I've always gained a lot by going through this exercise and then reading some of the thoughtful comments you all share. The goal here is not to be right, although that always feels good. The goal really is to stretch our thinking and expose ourselves to different scenarios and different alternate outcomes. That's it for today. My name's Dave Keller with Market Misbehavior. If you want to follow how the market actually does relative to these levels, watch our market recap show every weekday after the close here on my YouTube channel. For Market Misbehavior, I'm Dave Keller reminding you it's always a good time to own good charts. Have a good one, folks.